Okay, we're all set.
Okay, thank you, Paul. This is Jim Joe and Paul Demers. Today is August 7th, 2017, and this is the Monday Market Muse. A quick disclaimer before we get started. Capital discussion, not a broker-dealer investment advisor. The presentation is not to use for educational purposes only. We have no way of knowing your situation or what level of risk is appropriate for you. The risk of trading options can be substantial. Please be aware of all risks prior to placing any trades. Trades we end up talking about today are going to be computer-simulated trades. We believe them to be accurate, but your profit and loss will vary due to such factors as commissions, slippage, and thank you. Paul, thank you so much for hosting.
No problem.
Co-hosting with me. It's I'm actually visiting my wife's family. We're down in Puerto Rico, and my internet access is okay, but it's not consistent. And so hence I asked Paul if he would be kind enough, which he was, to step in and help with this presentation. What I normally end up doing, Paul, is that I go through a bunch of different charts, and I'm saying where the market is. The bottom line is that, we're in this incredibly bullish environment, long term. Every once in a while, short-term factors show up that means that there could be a small pullback. But over the last couple of months, most pullbacks seem to end up lasting, 2 to 4 hours, okay, and then we rebound. So I don't see anything on the horizon that says that there should be major fear. I do see some things that we're probably getting closer to one of those, pullbacks. But those pullbacks, if they're more than 10 points, they're a lot these days, it seems. Just in your general trading, from a high level, what do you see?
I'm seeing the same thing. Of course, I am enjoying this very quiet market. The trades I'm doing now need that. But, we are consolidating up here. And the longer we consolidate, the bigger the move out of the consolidation is what I'm thinking.
Yeah, we use the analogy of compressed spring, right? When you go through consolidation, as Paul ended up mentioning, and Paul, maybe you could just highlight, the last couple of months, okay, on this. What you're looking at, excuse me, what you're looking here is the channel that started up at the end of 2015, beginning of 2016. Those are the blue lines going up, the aqua color lines that are going up. The brighter blue line is the support line that we ended up having started at the very end of last year, at the beginning of this year. And you can see it basically supported the lows from the end of December, January, February, and the bounce up that we ended up having. You can also end up seeing that the rate of descent of that support line was steeper, meaning that it was going from lower left to upper right at a greater rate than that overall channel. And even though it started, close to halfway between the two channel lines, we are now above it. If you highlight just the last few, say, 15 days or so, what you can end up seeing is that brighter blue line has ended up actually overcoming. Yes, thank you. That's exactly what I was going to end up asking you to do. By the way, what Paul's doing right now, Paul, and then just highlight that area.
See if I can make it bigger here.
And then you put it there. That's exactly, okay. See what Paul's doing is just adjusting the chart. So what I wanted to see was that brighter blue line, how back in mid-July, we actually got above, and you can even make it a little bit bigger if you want to expand it, so we can see. It expanded above the bright blue line, okay, which was the support line. Originally was the support line. We've come below it a few times, but currently over maybe the last 2 weeks, it's acted as a pretty good support line in terms of where we were. Now, over the last 2 weeks, if you take a look at the long-term channel, the aqua color line has been acting as a support line underneath the recent candles. However, starting about 6 days ago, when we had that intraday sell-off, what was it on, like the 26th or so? we dropped below 27. We dropped below that blue line, and so now we kind of have these tracks, okay, and they're getting wider, right? So we have the support / now resistance line above head, and we have the long-term channel below us, and they're moving sideways. And so what ends up happening is we go through this sideways consolidation or this time consolidation. One of two things will end up happening. The long-term trend lines will take hold and we'll move back up and we'll move back up. We've been tending to, since the U.S. elections, when we move up, to move up in pretty big spurts. Find a new support level, okay, or resistance level, and then go sideways for a while and then attack the next level. And that's probably what's going to end up happening. If you take a look at, let's say, if we go back to on the chart, I want you to look at like the 515 to 522 area, right? We had this sell-off, and then over the next week and a half, we rebounded, and we got all the way up to 24.19. Now, 24.19 was the high after that run-up, and then we moved sideways for 3 days. And so that's why the 24.19 level becomes an important price level that would acting as support or resistance. When we broke through the 24.19 level, you can see it took us a couple of days, and then we got up to as high as 24.40. Then we moved sideways for about a week and a half before we ended up breaking. So every time we end up breaking a level and getting to a new higher level, I've been drawing these price levels, and they act as pretty good support levels because look, after we ended up breaking that and we got up to 24.55, well, once we ended up breaking down, look at how well that 24.19 ended up being the support level for the big sell-off. When you take a look at the next day, we got below it, okay, and this was on what, the 2 to the left or 3 to the left, Paul? Yes, on there on the 29th. Right, we broke through that 24.19 level, but we rebounded and closed above it. And so what happens with any of these is that I try to draw all of these things on the charts where I know that the bulls and the bears will end up having some type, they've had a battle before, and they tend to end up having new battles on their old battlegrounds, if that makes sense, right? And so you don't know when we have a sell-off which one will end up holding. Like if we start to drop, okay, from here, and we'll talk about dropping and we'll talk about going up. The support levels we'll see is first the aqua color blue trend line, okay? If you take a look at today, Paul, the aqua color blue trend line, if you just move yes, perfect, right there, right? So that would be the first support level. Let's call that at 24, 72 or so, right? And then below that, we know that there had been battlegrounds at 24.64 and at 54. And so depending on the algorithms, okay, and also the large institutional, okay, money managers, when we end up having a sell-off in a bullish environment, so what we're talking about is we're talking about a counter-trend move. When we have a counter-trend move, normally there's been more of a pullback, finding a support level, and then moving to higher ground. Here, the pullbacks have been very small, and we haven't had any medium-sized ones. Let me put it that way. What ends up happening is that we have these small, 2-hour pullbacks, and then we move higher. And if we do have any pullback like we had several months ago, they only last maybe a day or two before we end up finding our footing and then moving higher. And so at what level will the bulls step in? And on this chart, I've given you at least the next half dozen steps where the bulls may end up choosing to mount their defense. They'll choose at one of these points. I don't know which one, but you can end up watching, and you don't have to end up making your bets, before the race. You don't have to make your bet on, I think that this one's going to end up holding. Let the market play out. See if it ends up going through it, if it holds it, if it starts to end up bouncing. Then yeah, you can end up playing. It doesn't mean that you won't get faked out. Many times they'll end up pausing at a support line and then breaking down and going through it. But these are excellent places where you can end up choosing to end up putting on your trades. Like, for example, many of you, like me in my Kevlar trade, may end up being more negative delta in your butterfly or your condor than you'd like because the market just keeps going up and up and up. Well, what can end up happening is that if there's a pullback, say to 24.54, at that point I'm saying, okay, you know what, this would be a really good time to adjust because I unlike I guess a lot of people, I like to end up adjusting against the market. Yes, I need to end up rolling up, okay, on some of my trades. But I have one of two options. I can either end up rolling up when the market's going up like everybody else, or because my risk profile in my Kevlar trade and a lot of my other trades is very, very flat, I can end up withstanding, okay, the market moving against me for a while. And then when it ends up pulling back and it pulls back towards my butterfly, I tend to end up getting much better prices. Does it always work? No. What's my risk on the upside? You know, risk is going to end up being that you can be in that, you know, valley of death or whatever you want to end up calling it to the right side of a butterfly. But it's limited, right? 5, 10%, maybe a little bit higher if, you know, you really want to battle it and languish. But, you know, you're not going to end up taking any really, really bad hit. I'm not saying that losing 10% on the trade isn't bad, but one of the things that ends up happening is that I've found that if you try to pull the reins too tight, if you try to end up eliminating all of your risk or, you know, as much as possible, you also end up really just choking the long-term performance of your trade. The best quote was, I was in a seminar, speaking in a seminar once, and Tom Sosnoff was also speaking there. And somebody asked Tom the question, said, you know, Tom, can't you end up eliminating more risk? And he said, yeah, I can eliminate more risk. I can eliminate all risk. But if I eliminate all risk, I'll also eliminate all profit. Okay, I got to let some of the risk run. And I think that's probably one of the most unrealistic expectations that newer traders have, is that, oh, I can end up putting this trade on and I want something that, you know, always wins, makes lots of money, and never loses. Yeah, well, so do I. When you find it, let me know. Okay. You know? So it's you kind of have, and there's some risk. Now, I'm not saying you should ever become jaded or cavalier about it, but I am saying that you have to end up knowing, if this is what happens in the market, here's what my reaction is going to end up being. The more you end up trading unemotionally, I think the stronger your trade gets. You know, there's another old expression, Paul. You remember I used to use this one: scared money never wins.
Right. Okay. Absolutely.
And so, anyway, so that's where I end up seeing the market. It's, you know, do we end up getting a pullback? Paul, I don't know if you can end up finding it, but I called it the VIX term structure. It was the one with the VIX futures.
This one?
Do you remember? Yes, perfect. That's the one. Wow, you were quick. I thought I was gonna have to stall while you looked for it. Anyway.
Depends how well Toss is working on my machine.
So what I wanted to end up pointing out here is that the candlesticks are the actual VIX. And the VIX, remember, it's a calculated index. So if some large money manager decides that he has a bunch of calls that he needs to sell, okay, that's going to drive down, right? Selling drives down implied volatility. That's important to end up realizing, right? Selling will drive, if you sell something, and this is true of anything, right? If there are a lot more sellers than buyers, you're going to end up driving down the price. Well, price, how high prices are and how high implied volatility are directly correlated. If price goes up, implied volatility goes up. If you say, well, what happens if volatility goes down? Well, the price of my options is going to go down. So if you get some guy who's doing, let's say, their quarterly roll for their, 100,000 clients, where he's managing, $100 billion, and he does covered call strategies, he has to sell all of his covered calls, it's going to drive down volatility. What happens if everybody has to end up re-hedging, okay, and their old hedges have expired and everybody has to put new hedges on? What happens? Well, then they're going to be buying, and if they're buying options, okay, it's going to end up driving implied volatility up. Now, please realize, that it doesn't make a difference if you're doing puts or calls. If there's a huge amount of call buying, that would drive up implied volatility also. And so what ends up happening is that when you look at the VIX is the result of market factors, okay? And hence, there'll be more spikes both up and down in its implied volatility, and I would call that noise. So when you take a look at the spike that we had a week ago on Thursday, where, on that Wednesday we ended up reaching a low of 8.84, and then we ended up moving up to around 11.2 in a single day before we started to sell off a little bit more. I'm not saying that there wasn't some fear in the market there. There definitely wasn't. There was more put buying than call buying. But look at how much the VIX went up versus the bright blue or that whatever dark blue colored line looks like. That dark blue colored line is the front month future. So that is the front month future for August, and it happens to be, by the way, for those of you who end up tracking it, okay, VIX calls it the VXQ7, Q for August, the 7 for 2017. You can see how the August futures moved up, okay, during that, but they didn't move up nearly as much as the VIX did. Now, what normally ends up happening on this graph is you like to see all of the futures lose value over time. This is in a bullish market, right? If you're a bull and you want to end up seeing what ends up happening, having these go down over time. Now, what are these, right? I end up showing you where the August ones, but those colors of the rainbow, they're just each of the futures. So the one that Paul's pointing at right now, that's September. And then if you open it, you can see it's the U. And then the green is going to end up being the October. And then the yellow is going to end up being the November, and then December and January. Okay, so the red line at the top is January 2018. Now, what I want you to end up noticing here is that while the VIX has continued to end up dropping, from 11.2 down to 10 even practically, the VIX futures in August have come down a little bit. But look at what's happened as you go further out in time. As you go further out in time, to the October, November, December, and you get all the way up to the January, they've actually increased over these last few quiet days. That's a sign that institutions are preparing, okay, that they're getting ready, okay, for a market to end up, okay, being more volatile, okay. You don't see it. There's no ticker symbol that comes across when you're watching your CNBC. It's information that you can only find when you end up going this type of analysis and work to be able to see what's going on. Now, just because they're scared, does that mean that the market's going to end up going down? Hell no. It does mean, though, that they're in heightened awareness for it. And so that when this thing happens, two things occur. Number one, is that it does increase the likelihood that we will end up having a smaller pullback. Number two, it does end up increasing the likelihood that that pullback will at some point be limited. Why? Because the bigger institutions have already put their insurance in place. So, and this is exactly what we've seen, right? We've seen these pullbacks, okay, go 1 or 2 days, okay, in the worst case over, since the election. And then they end up finding their footing and they're moving higher. This chart shows you exactly, why that ends up happening. It happens because they're putting their longer-term position, their longer-term protection in place, and so they're in a better situation to handle any type of market pullback. This is one of those things that I call an elephant footprint. Looking at the ratios and how do you end up determining how much is a lot, what math do you do, which months do you end up using? That's what I spent 5 years on, okay, developing Vol Vantage. Okay. Paul, do you see other things in the market that are going on that either confirm that, things just seem to be going very smoothly or anything that has you a little bit worried?
Well, everything has me worried. But, what I noticed, I follow the standard deviation and the ATR combined. And what I found is when I look at the two of them together, they're both very, very low. Now, that doesn't mean the market's going to correct or go up. It just means that we're trading in an extremely tight range. So my concern is, the breakout. Which way is it? You're never going to predict which way it's going to go, but I'd like to try and figure out how big it's going to be.
Right. Do you have a specific chart that you use, or do you want to end up pulling up the 7-day ATR chart that was in the batch that I sent you?
Let's see if I can find.
It's an SPX graph. There's only one study on it on the bottom, and it's the ATR. There you go. Perfect.
There you go. Okay. So I'm going to, if you give me a second, I want to change something. A couple of things. I'm going to add the standard deviation.
Channels or just the standard deviation itself?
Just the standard deviation.
It's up there a little bit. It's got halfway down the page. Standard deviation says.
There it is.
That's the one?
Yep. Add this one.
Do you leave it 14 days, or do you make it smaller?
14. And I make this one 14. And I need to make this one different color. Look at that. Not very often that they're like that. It's very, very unusual. When you go back back in history, it's very unusual that you get the two of them together.
To be that low.
And you can look at this like this time frame here where they were both that low, and then the market rolled over. But as I go back in history and look at it doesn't necessarily mean the market's going to roll over. But there sure is a lot of complacency in the market right now. That has me concerned.
How about if you switch to both to 7 days?
Yeah.
See, by the way, one of the things that Paul and I used to do all the time is that if you look at things in different time frames, they can give you different answers. Obviously, by making something half as long, right? We're going from 14 days down to 7. It's going to end up showing quicker bounces, but those quicker bounces could also end up being more noise.
Right.
Okay. So
it's a tough balance, right? To trying to figure out which time frames are better to look at.
Well, you know my friend Andy. He is a private investor. He's a retired Merrill Lynch guy who's been retired. He retired, I think, probably at about the age of 32. He made enough money, retired, and just manages his accounts. Whenever he asks me to do any technical analysis for him, we always look at things on daily, weekly, and monthly charts, okay, because he's a longer-term investor. And so what we're looking at for here is clues that things will start to end up breaking out in one direction or another. When they end up getting this low, a lot of times there's no room to go except for up at one point. And that just basically means that the daily ranges will get wider. And as the daily ranges get wider, as Paul said, we can't end up determining whether it means up or down. A couple of facts, though, that I want to end up reminding everybody of history. Number one, and you know what, we'll do this. A lot of people know this. What's the worst performing month of the year in equities? Paul, you know this, so don't understand. Anybody, go ahead, type it in the chat. Come on, somebody has to want to play. Can't just be Paul and I all the time. Historically, what do you think the worst month is? You're 1 month off, Perry. actually September. September is the worst month, okay, for equities. Yep, that's right. It follows then, a lot of people don't think this way, but this is actually true. What month historically has had the largest increase in the VIX? So what's the best performing month for the VIX? Now remember, the VIX is a 30-day leading indicator. And so, yes, the VIX does end up going up sometimes in September when the sell-off's really bad, but that's not what drives the VIX. The VIX is the anticipation that things might get bad. So actually, the best performing month, okay, in history for the VIX is August, right? Which makes perfect sense if September is the worst performing month for equities. And so when we take a look at how everything is so compressed going into the month of the year, or in the month of the year, that where implied volatility gets the highest. And you already saw that, right, in the VIX chart that I showed you, in the VIX futures chart with the term structure, that the longer-term ones were starting to move up already. They started to move up, but this market hasn't sold off. What's going to happen if the market starts to sell off? They're going to go up even more. But remember, when we talk about performance of the VIX, we talk about it as a percentage move. So if you think about it, if we enter the month at 10 and we exit the month at 14, it's not like 14 is such a big deal, but that was a 40% increase in the VIX, right? That's a really big increase in the VIX. And from there, it can end up getting worse. Now, it's not going to end up just moving unless there's some factors driving it. We don't see anything in the market that is, terrible. Corporate profits haven't been bad. GDP growth is really terrible. I mean, isn't terrible at all. We've been growing. You'll see stuff, and it's, by the way, if you want to end up actually becoming a better investor, my suggestion is to turn off the news. Okay, since we've been down here, right? We came down on Saturday. They have CNN on a lot. I'll end up watching it, with the exception of the History of Comedy show that I watched last night, which was a great show on CNN. The show about the 90s and their travel shows. There wasn't one show that I saw that didn't have things about the Russian scandal and the Trump administration. I'm like, how does that end up affecting, the market? I mean, it's entertainment value. It doesn't end up having any effect on the market. If we actually got to actual hearings, or impeachment, then we can start talking about it. But right now, they have nothing else to report on. Either that or, remember, their job is not to end up informing you. Their job is to end up getting as many viewers and entertaining as many people as possible so that they can end up charging more for their advertising spots. That's their business. And so it's
That's
just,
right.
It really is, right?
There's no other news in the world. I'm going to put my 2 cents in because I don't like talking politics. But evidently there is no other news in the world going on that's worthy of reporting.
It really is ridiculous. And I don't care which side you're on. Either side, come on. No matter what side of the political fence you're on, at some point you have to look at this stuff and kind of laugh and think it's ridiculous from either. So anyway.
Of course, I sit in front of the screens all day, and I have, my news sources on. And, we worry. You spoke about, what's going to be the catalyst to go down. The only thing that I see going on that pushes the market down in a reaction is political news.
Right.
Now, nothing else what's happening in Korea, that threat. Nothing else. News about the Feds, employment numbers, none of that means anything. The market's poo-pooing everything except for the announcement that there was going to be a grand jury.
The only thing that really ends up affecting you is and the markets, right? That's what we're talking about. What's the only thing that really ends up affecting the markets is the economics of the entire situation. Okay? Right. I think that you should end up being much more concerned over what happens politically. Will this, in the future, increase our cost of running government, and hence at some point we'll have to end up increasing taxes?
Well, I think that,
to maintain. I'm sorry, Paul. I was just going to say, or will this end up helping maintaining or lowering the cost of government, in which case taxes won't have to end up being raised? You can't keep lowering taxes and there's no consequences. See, to me, that's what ends up affecting markets. That's what ends up affecting things that people end up worrying about. So the bottom line on it is that when I think about what type of news would end up affecting markets, things that would end up creating an environment where growth slowed down and we went from positive growth to neutral into negative growth, which is 2 quarters of negative growth is a recession. What do I think would end up causing issues? Other things where environments would end up happening which would change supply and demand, and which would end up meaning that companies wouldn't have as much demand for their products. They'd have to lower their prices, which in effect would end up lowering their earnings. That would end up hurting the market.
Right.
None of those things are in place right now.
Right. That, in my opinion, is the cost of borrowing. You know, once the cost of borrowing for a corporation gets to the point where it becomes economically unfeasible to borrow money to buy their stock back, then we will see a shift in the market.
Yeah. See, because the thing is that companies aren't a hell of a lot different than home buyers. Okay, what caused the whole housing bubble? It was that nobody ever looked at how much money that they were paying to buy the house. They were looking at what their monthly payments were. And if you artificially end up keeping interest rates low enough, like by having zero or interest-only loans, or even having negative amortization loans where you're not even paying off the full interest of what you end up borrowing, okay, that causes prices to end up, going up. Why? Because people only look at what they're paying and think, hey, for the same $2,500 a month that we were paying to end up buying that $500,000 house, now I can buy a $750,000 house. And so what ends up happening is that everything goes up. If you think about the three of the biggest expenses that people end up having. Now, Paul, I know you're already through this. I still have 2 more years of it. But of the 3 expenses, the number 3 can end up being college tuition. Okay, I have a daughter in Boston University, and I'm intimately familiar with how expensive colleges can be. 2, people take a look at their car payment. 3, they take a look at their house payment. Now, on 2 of those 3 things, the government, over history, have thought they're good things for us, right? They thought it was great if we ended up buying homes. They thought it was really important, to be able to end up people to get educated. So they came into our lives and they tried to help us, They tried to help us by giving subsidies to different things, lowering costs by giving away free money. They ended up doing things like passing laws so that there could be a greater percentage of the population, regardless of ethnic background or anything else, that would be able to end up buying houses. And so by doing that, they actually ended up taking some of the companies that were servicing the lower credit-worthy borrowers and pushed them even lower, and things got well out of hand. You guys know what ended up happening, that was the catalyst towards, greedy bankers, greedy homeowners. Yes, greedy homeowners, because they wanted to buy more houses for less money. Bankers wanted to make more money. And the environment was set up where the government was helping us, and they ended up putting in Fannie Mae, Freddie Mac, and a bunch of other things to be able to help us. Same thing with Sallie Mae, with student loans, right? They did all of these different things to be able to end up helping us, You take a look at one of the biggest problems we have today in our economy, it's the student loan debt. It's just crushing, the younger generation. You take a look at, of those 3 expenses, which of those 3 didn't the government ever say, we're here to help you? It was car loans. And what's happened to car loans during, the 50-plus years that I've been on this earth? Car loans, have basically been about the same percentage of the average American's income, their take-home pay, the same percentage for years. We have never had a car bubble. You don't end up seeing any of these things. I've often said to you, right, the 10 scariest words in the English language are, I'm from the government and I'm here to help. They've tried to help in housing. It's been a disaster. They tried to help in student loan. That's an impending disaster. So when I take a look at the bigger picture, the big markets, that it's those types of policies that would end up affecting how governments can end up regulating appropriately so things are fair, but not meddling in the free markets. I mean, and that's the balance, okay, that you end up seeing. And that's why, Democrats and Republicans, okay, hate one another. And, that's how come I've never registered for any party, and I never will. It really comes down to a pragmatic approach. What does all of this mean to the market? It means that, we're in an environment that the market views as market-friendly, lower regulation and lower tax. And no matter how much, an investor may end up hating Trump for what he said or what he ended up doing, the markets end up saying, we like lower taxes, we like less regulation. And so hence, as long as those things are in place, there will be an upward draft on the market. Anyway, Paul, not a lot has changed. We're in the dog days of summer. I see us moving, through this time consolidation. When we do break out, I do see a breakout. I do see this compressed spring moving. But, if we ended up moving, 50 SPX point, I think that would be a huge move.
Oh, I agree. I think that something dramatic has to happen to make it move like that.
Yeah.
I think we're just going to keep, you look at this range, and then we bumped up, and then we look at this range. They tested it, the previous range. Now we're in this range, and now we bumped up. So, if history's rhyming, what's my guess is we're going to be in this range, and we're going to go up. Now, Andrew has said before he thinks 2,500 is a target. I agree with him.
I think so too. Paul, can you do me one favor? One of the things that we found is that in the SPX, because of the study that we had done, if you remember the spreadsheet that I had done, it shows that the high frequency and algo guys have created many more days, closing days, where we have narrowed the gap. So in your standard deviation, instead of choosing the closing price, right, can you see what your other choices are? Can you end up having a range?
Yeah, we can do high-low divided by 2.
Perfect. Choose that one. Very little effect. Okay, that's what I wanted to see. Only because the thing is that I do know that the ranges or the closes have been closer. What I hadn't done in my study, I hadn't taken a look at the daily ranges. And so I just wanted to see if that had much of an effect on the standard deviation. The answer is it hasn't. We're still very low.
Yep. I mean, it has ticked up when we changed it from being straight down.
Paul, go to a tick chart on the S&P 500. This one I didn't send you, so you're going to have, or just go to a 1 minute. I don't care what you're going to choose.
Okay, so let's see.
Just a 1 day, 1 minute I want. 1 day, 1 minute. Yeah, I just wanted to show everybody. I had seen that happen on my other screen. So I don't know. We do end up getting this, right? We do get these little quick moves. They usually end up finding support very quickly and then bouncing back up.
Well, we're getting to the 11 o'clock time frame where, one of my trading buddies and I, we'll go long the futures at 11 o'clock and just not worry about it and close it out at the end of the day.
Right. Now, what happens is that usually works best if there's a sell-off in the morning. We usually hit a low between 10 and 11.
Right.
Sometimes we've hit the high of the day in the morning, and when we hit the high of the day in the morning, it's usually by 10 o'clock we hit the high. Playing the reversal. You open up, does it move higher? It's not a bad trade because sometimes we've opened up higher and we've continued to run higher, but if you put on tight stops, if you're a day trader, playing the reversals has been a trade that's worked well. It's been obviously in a market that's been up. We many times open up flat or we'll move around. We find that low somewhere between 10 and 11, and then we move higher on the rest of the day. And so it would not surprise me if we end up having a little bit more of a sell-off. We end up finding our footing, within the next half hour, but then we move higher the rest of the day.
Right.
We'll see.
Yeah, it's hard to predict. Tight stops.
Any questions? Paul, any other comments? And I'll ask everybody else, questions. Okay, we're going to talk about DX in just a second because there's definitely stuff going on there. But, Paul, any other comments you want to end up making? And, guys, right, any other questions also that you have down? But Paul, why don't you start?
I don't really have any more comments on the market. I'm kind of in limbo here, waiting for them to tell me what they are going to do. You know, when you look at the charts, you really can't. It's hard to make a prediction, anyways. You know, so my biggest thing is, where is the market? Where can it go, and am my positions protected enough? But there was are you watching the chat?
Yeah.
Oh, okay, so you saw that question.
Yeah. So I wanted to end up getting into, before I jump to the currencies, I wanted to end up saying, is it a question about a specific currency or the dollar strength in general? I always have a harder time just making broad comments about the dollar without having a reference to which one are you looking at. And, so I know a lot of times, I don't know, Paul, do you look at a specific currency? I only look at the major ones. I look at the U.S. dollar versus the euro, the pound, and the yen.
Yep, that's exactly what I follow. And, for a long time it was just the yen. And now with the European Central Bank fiddling around as much as it does, I watch the euro at the same time. The pound, not so much. It's because the pound to me is more reactive now on how they're handling Brexit and what their future is, and they're manipulating that for that effect more than what the global markets are doing. But I find it interesting to watch the currencies, but as far as how they will affect the market, I'm not sure, unless there's a dramatic change.
Would you pull up a daily chart going back 20 years on the yen? Not on the yen, on the euro. So what you can end up seeing is that if you go back far enough, you can see that we had a pretty big pullback towards late 2014, where the yen went from a high of around 140 to, it didn't get quite down to parity. Parity is 1.0, by the way.
No, did you want the yen? Or you wanted the euro, correct?
Yes, I'm sorry.
Okay.
Okay. And so I was just looking at my other chart because I'm on a one system. Okay. So what you can end up seeing here is that if we end up going from the high that we saw in that, let's call it April through April time frame of 2015, where we ended up getting up to about 140. Over the next several months, we came all the way down to like 104. By a year, as we got into, say, 2015 of April, from 2014 of April, over the year, we were from about 140 down to 104. We bounced in a range, and we even got lower than that as we went through the whole thing in and around Brexit and everything else. Okay, when I take a look at the lows that we got to, let me just take a look here. The lows that we ended up getting to, let's say, at the end of 2016, okay, we ended up getting 2016 towards the election. We got very, very low. We got down to the 103 level. And what's happened is that since about April of this year, we started to move higher. And so we're definitely in a trend where the euro is getting stronger against the dollar. Okay, that means that the dollar is getting weaker. Okay, against other currencies. So let's talk about that from two perspectives. What does that end up meaning? Well, it depends if you're using your dollars to buy other currencies, or if other currencies are buying U.S. stuff in their currency. So a weaker dollar means that it is cheaper for technology companies to export technology out of the U.S. into other countries. So this is really good for companies, let's say, like FANG, right? Microsoft and Apple and Netflix and Google, right? Because they all have, most of their costs are in U.S. dollars and their sales are around the world. So if they can get more dollars for their same product, so let's say if you're selling a product for 100 euros, well, today, okay, that 100 euros, it would end up translating to more U.S. dollars than it did, say, 4 months ago, 5 months ago. And so it's good for U.S. companies. Now, the thing is, who's it bad for? It's bad for us when we want to end up buying stuff. And since we import more than we export, okay, it's usually bad. We used to end up joking because for many years, okay, the U.S. government stance is we wanted a strong U.S. dollar. We wanted the dollar to be king around the world. We wanted the dollar to be worth so much money. But what that did was that kind of hampered, okay, American business, okay, to export. And so they'd say that out of one side of their mouth, but they were really trying to make the dollar weaker. So this is a trend, okay, that has broken out. And for those who have been traders, I know that a lot of my currency guys that I've spoken to, or just some of the analysis that I've read, they've been, short the dollar, okay, long the euro, whatever you want to take a look at, but for a while now. It's a trend that will probably end up continuing because of what's going on in the markets, both in Europe and here. What's one of the biggest effects? One of the biggest effects is that the U.S. is trying to end up increasing interest rates, right, where we're going through the normalizations of our balance sheet. That means that all of the bonds that the U.S. government had bought during quantitative easing, they'd like to try to end up selling some of them because they have so many of them on their balance sheet right now. And so that would end up making interest rates be a little bit make things a little bit more expensive in the U.S. What's going on in Europe? Well, Europe and the rest of the world, their economies they haven't been growing for as long as we have. They've come out of their recession later. So many of the worldwide market analysis would end up saying that foreign equity markets are in better position than U.S. equity markets. What does that end up meaning? It means that large amounts of money will flow out of the U.S. and into, say, European companies or into the euro. Hence, that would end up when you transfer money from the U.S. outside to other countries, you're selling dollars and you're buying euros. That would end up making the euro stronger, and that's what's happening. That's between interest rates and company flows, and these are things that don't end up changing overnight. And so long term on this is still bullish on the euro. For at least, when I say long term, I'm thinking, out a year. Short term, it's run up a lot. Can we end up seeing a pretty quick pullback? Yeah. Okay, you have some more risk in the short term, but this thing looks very bullish, okay, in the long term.
I've got a couple of comments.
Okay.
I've got a couple of comments.
Go ahead. No, go.
So I put up a chart of UUP, which is the bullish index on the dollar. And, as far as the stock market goes, when you look at the chart in mid-2014 and the run-up in the dollar and where we've been bouncing around, it really hasn't affected the stock market. So this, I guess I look at, the dollar weakening or strengthening, you have to kind of put it, to me, you have to put it in context of where we've been and what's going on and what the markets have done and the economy has done when the dollar was weak, in 2012 and 13 and half of 14. Compared to where we are now, if you look, the dollar's gotten a lot stronger and the market's gone up. The theory that, we want a weak dollar because it's better for our economy. Well, it's better for the global international companies. But when you look at the amount of money that is generated within this country by the companies that are in the Russell, and a weak, strong dollar is better for the consumers and the rest of us because it makes everything we buy cheap. Oil becomes cheap, gasoline becomes cheap, the imports become cheaper. Those big companies that are making all their money and having to convert it into U.S. dollars when they report, the Apples, the Coca-Cola. I own Coca-Cola, and I find that Coca-Cola moves up and down. It's a good currency indicator because as the dollar gets stronger or weaker, Coke moves in that direction because a lot of their money is made overseas. But for the rest of us, I want a strong dollar, because it makes...
Any tourist wants a strong dollar, right? If you're planning on going to Europe, you want a strong dollar. If you're
absolutely.
A Coke dividend, right? If you're a Coca-Cola shareholder, you want a weak dollar.
That's correct. So, which one is good for our economy is based on which economy you're looking at, the profitability of these big corporate giants or, your pocketbook and your budget.
Right. So for the Demers household wealth, it's better for a weak dollar because you want Coca-Cola to go up. But for the Demers budget, account, I'm sorry, not their budget account, their travel account that they budgeted to go to Europe next summer, that you want a strong dollar. Okay.
Correct. Or buying gasoline. I want a strong dollar.
Yeah. Sure. So it depends on what you're a buyer or a seller of, whether you want a weak dollar or a strong dollar.
Correct. But, when you look at this chart, it really didn't affect our economy all that much, and it certainly didn't affect the stock market that the dollar gets, it really took a jump up there in the middle of 2014. And it didn't seem to phase the markets that were now up here. So, we get a little, I don't think that's personally that's going to affect my trading. And the GDP numbers don't seem to affect the market either. The GDP numbers come out, and it's like, wow, that's a miss, and the market goes up. The employment numbers come out, it's a miss, the market goes up. The employment numbers come out, and they're good, the market goes up. It's none of it matters anymore to the market.
Yeah. Elephant footprints, somebody's asking me for. I can't end up commenting about elephant footprints in the currencies specifically because I don't watch them close enough to be able to end up telling you that. What I do end up watching is the equity and the bond markets to a degree. Couple of the elephant footprints that I ended up seeing was, Paul, on this chart, could you get rid of the standard deviation and just show the simple, the ATRs?
Sure.
Okay. Because this is as a percentage.
Let's see.
That is.
So you just want
bottom,
this?
Yeah, just delete that one. Just delete it. Okay. You can also not show it that way, so.
Then I'll have to go find it.
Okay.
So let me make it bigger?
No, yeah, you can just highlight currents, okay? One of the things that had happened is that ATRs got bigger back in early July, and one of the elephant footprints here is that they've started to end up going down, gone down a lot. They started to bounce up a little bit, but they got very flat again today. Okay, so they've drawn it down. That's because, that large day has moved off of the chart, because I'm only looking 7 days back. And so the bottom line on here is that we don't have a lot of movement, okay? So an elephant footprint would be if this starts to end up moving up, okay? You could also use standard deviations. I'd end up using the high-low, okay, -2. That would be something that would end up being negative. Right now, there's no elephant footprint here. As you can see last week, if we would have had volatility continue to pick up, that would have become an elephant footprint. Another one of the elephant footprints that I end up seeing was that the longer-term VIX futures, and if you could go to the VIX term structure, that ended up being something that looked like if it continues to go up, I would end up worrying about that. Where will you end up seeing that? You can end up tracking, if you don't want to do all of this, the problem is that you really need to end up seeing, and Paul, could you just open up the study so somebody could end up seeing what I've done here? Just open up all the little, yeah, you can do that. You could also do the little beaker. There is, okay, the formula that I'm doing, and all you can see is all I've done is, and you can leave it right there, because those are the only ones that are showing. I put in the rest of them so that I don't have to look them up later on. If you take a look at anything beyond the one that you have your cursor on, the VX, F8, all the ones below that, I just haven't shown. And what I end up doing is that I end up changing my colors every single month, so I have to do a little bit of maintenance on this. If you open up this one, okay, what you can end up seeing is that I choose the color, I make it bright blue, and that's it. It's as simple as that. And so I'm just listing out all of the futures. And you can go and you can see what this looks like, okay, on other charts like, let's say, VixCentral.com, but it won't give you the history. You can't end up seeing how things trend on it. Here, by keeping a 5-minute chart looking back or a 15-minute chart looking back 20 days, I have a good feel for are things increasing or decreasing. And you can see to the right of the windows that Paul has open that the red line at the top, okay, is going up at a steeper rate where the blue line is moving flat. Is that a precursor for something to start to end up moving? Well, the blue line will continue to be flat and continue to end up going down because don't forget, in how many days we have left to expiration, maybe about 2 weeks or 2 weeks and 2 days, I think. The blue line at 11:15 will have to end up going down to end up meeting the actual VIX, which is at 10:03. And so that difference will disappear in the next few plus whatever weeks. Within less than 3 weeks, let's just call it. I don't know it's either the Wednesday before or the Wednesday after. My system. And so what does that end up meaning? It means that if the futures come down toward X, which happens probably 8 or 9 times out of 10, then the longer-term VIX futures will also start to subside and they'll come down. However, if the VIX starts to end up moving up and the blue line ends up not moving at all, it's noise. What happens if the VIX starts to move up and the blue line is just the VIX futures? If it starts to move up, there's your elephant footprint. The elephant footprint is that the longer-term, VIX futures have started to creep up. If the VIX and the VIX futures, meaning the front month, the blue line, whenever anybody refers to the VIX futures, they're always talking about the front month, unless they otherwise specify it. So the blue line, the front month VIX futures, if it starts to end up moving up, and if the range between, let's say, the blue line, which is the VXQ, which is August, and the VXU7, which is September, if the difference between those lines starts to end up tightening, not because the the aqua color line comes down, but because the blue line goes up, there's an elephant footprint for you. Those are things that would end up showing that there's some negativity. One of the things that I end up doing in my Vol Vantage analysis that I do out every day, I end up talking about this, and what ends up happening with the Vol Vantage indicators, when enough of these things get triggered for me, if things get negative enough, I will actually end up going long the VXX. Paul, if we close this and just open up a VXX chart, now please realize that after 5 years of doing the math and back testing and modeling, that what I found is that you can never pick. And I just want you to highlight the last couple of months. Maybe just that's good. The last few months. From there is perfect. You're never going to be able to end up picking from any type of analysis that I've seen where I can end up picking saying, ooh, this is the bottom of the VXX. I can see that it bottomed out. No chart reading works in this whatsoever. However, if this thing does start to end up moving up, and this is not anything that I use in my Vol Vantage stuff, it's just I'm telling you what I've seen as a result of it. I always see my results first in the Vol Vantage. There's less noise in it, but what will end up happening is that I will end up getting a signal to go along the VXX, not if we end up moving up to, like a 11.9 or maybe 12. I would probably end up getting into this thing once the VXX got higher than that. Where? I don't have a clue. 12.5, 13.5, but someplace around there where things were starting to get bad, and the elephant footprints that I showed you signal that things were going to continue to get worse. Staying away from the noise, okay, is probably one of the most important things you can end up doing. I know that some people say, well, Jim, I pay for a Vol Vantage service and I'm in cash a third of the time. Yeah, I know, but there's not a good trade right now, and that's why I do the analysis for the Vol Vantage subscribers every single day. I let them know exactly where the support levels are. What you've seen Paul and I end up doing, I do this probably, instead of using 2 or 3 charts, I use probably about 14. I do my video every weekend. I go through it in great detail, what's going on, and then I do a write-up every morning to end up explaining, what's happened in the charts, where I see support levels, where I see resistance levels. And so from an elephant footprint point of view, I tend to find them more in the institutional indexes. And the institutional indexes are not just things that you would normally think of. A lot of people think an institutional index might be the VIX, and to me, it's the institutional index that is actually, taught or shared with the public. Andrew asked me a couple of weeks ago if the VIX has become irrelevant. And it's not irrelevant, but it is actually used. In some ways, it'll always be relevant, but in some ways, the institutions use it to actually fool the public. You can end up seeing that by buying longer-term VIX futures, by buying further out of the money VIX puts, or doing VIX combinations of calls, okay, doing like a call spread in the VIX, or doing certain combinations longer term outside of the 30-day range that the VIX would end up calculating in the SPX options, they're able to end up putting on their insurance without affecting the VIX, and then the VIX tends to end up, when it does move, it tends to move very quickly and has a lot of noise in it. And so looking at the VIX by itself, which everybody always does, is not the right thing. This chart is another one of the elephant footprints. While I do not like the index that the SIBO has come up with, they have an index called SKU, where they calculate how expensive teenies are, right? The way out of the money options, and they compare them, and they have a whole formula. I'm not going to go through it, but they end up having a range, and what they do is they publish the number every single day. So it's a single print at the end of the day. That's where all of those white dashes are. How do you make sense out of that? Well, the way I make sense out of a lot of things is I put moving averages on it. So I put a 200, a 50, and a 20-day moving average on it. And you can see the green line being the 20-day moving average, that we are moving higher. And so that means that while they're buying these far out of the money puts, they're not buying a lot of them to affect the VIX. What does that mean? It means that the institutions be better prepared for a downdraft. Paul, can you just take that out to as far as you would end up go? Because one of the things I want to show here is if you take a look at the 200-day moving average, you can see how it moves a lot slower, but over time it has moved higher. Why? Because more institutions are doing this, and so these are institutional movements, and that's called alpha. Okay, that's that's a big thing. That's a big thing. And so I wouldn't be surprised to end up seeing, like I said, market pullbacks. But the way the market's positioning itself, if we do have a pullback, I can't see it. That 24.19 level that we talked about that's held several times is probably about as far. I know, Paul, I go all over the place, and you're pretty quick. Thank you for looking for it. That 24.19 level on the SPX is probably a level where I think, we're going to be hard pressed to end up breaking through. If we do break through the 24.19 level, there are plenty of other opportunities there, like 24.06 and 2400 that we would end up probably seeing them buying. But that's even if we ended up having that hard of a sell-off. I don't think we'd even get the opportunity to go there. The other elephant footprint is that the gap that we ended up having in our chart may very well end up standing. Okay, that gap. And Paul, if you could go back to one of the SPX graphs. Okay, that gap that we ended up having a few months back was something that was kind of important. It happened on July 13th. Okay, that wasn't a huge sell-off to be able to have that level of a gap. The fact that we also gapped through the 20-day moving average. Do you see that green line going straight through the center of it? We gapped through the trade because the 20-day has proven to be a pretty good support resistance line over the last, I'll call it, period of time when the markets have been ruled by the algos and computers and the high-frequency guys. That's a big deal, okay? We're above the 20-day moving average. We've been above it since that gap. So I kind of take a look at filling that gap would be, important longer term. If we do end up getting to fill that gap, we either fill it and stop near the bottom at around 24.25, 24.28, where the bottom is. And if we do end up going much below that, that 24.19 level ends up being really strong support. I would think that, if I got an opportunity to buying a 24.19 in the SPX longer term, that would be a really good purchase. And that's pretty much it. One of the questions is the skew is near 140. Put skew is relatively steep compared to the time-lapse skew. Yeah, what ends up happening is that I use that skew chart when it was up to end up kind of explaining that it's the institutions that end up buying a lot of those things. One of the things that's happened, and you have to end up realizing after Dodd-Frank, some of the rules as they were implemented, the bigger banks couldn't end up using as much leverage, which means that they couldn't end up giving as much leverage to their clients being the hedge fund managers, the algo guys, the high-frequency guys. And so what did they all have to end up doing, okay, to be able to manage their margin and trade as much as they would? They would have to end up buying teenies, okay, puts, okay, just to be able to end up saying, oh, if it does go that low, we don't have a margin requirement. So there was a greater effect of having to pay for those teenies because of legal legislation in this country. Okay, and so realizing that that, along with the high-frequency guys wanting the markets to end up staying very, very tight until they move them, and then they move them very quickly, ends up having the skew get steeper and steeper over time. Okay, and you can see that when it ends up getting steeper in the short term, like over the last 20 days, like it has been, that's driving the skew higher, which means that they're preparing more for the market to end up coming down. Okay, so those are all of the elephant footprints that I end up seeing in the market right now.
It's interesting.
Sorry about that.
Do you? I can show my skew graphs. Might be helpful with that 140.
That would be good. And Paul, I'm at a point now, as I told you, I knew my time would be limited, so I'm going to have to end up signing off now. But I think that, yes, you should show your skew graphs. And people, if you haven't seen Paul's skew graphs, let me tell you that they're extremely useful. Paul, any last things for me, though, before I sign off?
No, I think that's good. I'll just show my skew. We've gone on long enough, over an hour now, so I'll just kind of put these up and go over them a quick bit, and then I think we should be all set.
Okay, thank you, everyone. Paul, thank you so much for helping me out on this day.
Not a problem. My pleasure.
Take care, everyone.
So, when we looked at we can get this to show up, that 140 skew, and the skew is cheap, is expensive, the tails. And you're absolutely right, as of today. This graph shows the past 15, from 8/2 is the last data I have. So it's the past 15 trading days from 8/2, and the red line shows today. So you can see that the put skews have moved up relative to the last 15 days. So it doesn't surprise me that the skew is at 140. But I also did another graph that shows the relativity of the Ds, because as time goes on, the skew gets steeper and steeper the closer it gets to expiration. So this is a graph showing every 32 DTE expiration from the latest point of data I have. So it's 7/28 all the way back to 4/7. So when you compare it to previous time frames at 32 DTE, you can see it's not that steep. This is my, what I see in this. So that while we're steeper in comparison to the last 15 days, historically, we're still, pretty low, especially at the money, which is right about here. So, I try now and look at what's the first chart I look to see how it's changing short term. And this I started using to, where are we in comparison to history at 32 DTE? So it doesn't really scare me that the skew is at 140 at this point. I can't. What happens with this is, let's go back to the other one, see if it still shows up. So let's clear them all. Let's try 8/2. So when you look at the last few days, what I've noticed is you can see there's a hump right in here. So this is telling me where the interest is in buying the puts. It's down in this 2340 area. So, what I've found out in trading is that, buying a teeny, something down here isn't necessarily a good choice if everybody else is buying their protection up here. So you can start seeing how, and I noticed this going up in the last week from the middle of the week to the end of the week, that this line was starting to move up, even though the market was ticking up. So it gave me the impression that people were starting to get a little nervous. This is a spot, if you're trying to put trades on, when you're building a butterfly or a trade, you're looking at this area because this is where the premium is starting to build in. Unfortunately with the butterflies, there's no premium being built in today. It's still pretty low, for anything below the money or at the money. But the stuff out, away from the money is starting to get to the point where I might be interested in putting another trade on. But watching this, it's hard to see it in toss, looking at the different expirations, because naturally they are different. And I find it interesting looking between these two spreadsheets to see how they're relative to previous time frames has become important for me. So that's all I wanted to show. It's really tough to figure out, what indicators are going to give you the elephant footprints. I try to just be prepared for any changes, because you could get elephant footprints to the upside too. So, all right. Well, I guess that's it. We've gone on a long time, and I'm going to stop the recording. And I want to thank everybody for showing up.